This is the Net Group Investments Insights Podcast, where one or more of our experts explore a variety of views and insights that investors care about.
Hello, I'm Demisha Greater from Net Group Investments Multi-Management. This installment of your market and economic wrap is titled From Wall Street to Sandton, Markets Defy Gravity and Geopolitics. Wall Street is coming off a winning week for the S&P 500 and the Nasdaq, both of which continued to notch all-time highs. The S&P 500 ended last week 0.6% higher, while the Nasdaq climbed 1.5%. US stocks continued to charge higher in yesterday's trading session as the US earnings season continued to kick off on a strong note. According to FactSet data, of the 62 S&P 500 companies that have already reported so far, more than 85% of them have topped expectations. Bank of America said in a recent report that earnings for the second quarter are also tracking 5% year-on-year growth following the first week of results. The major averages could receive a further boost in the coming week should Alphabet and Tesla, who are the first of the Magnificent Seven companies who are set to show their report cards, manage to beat estimates. Meanwhile, across the Atlantic, the JSE All-Share Index broke new ground on Friday, surging past the 98,600-point mark to set a fresh all-time high. The local bourse finished firmly in the green in yesterday's trading session, inching ever so closer to breaching what would be a historic 100,000-point mark in its 137-year history. Commodity strength, resilient local earnings, and a weaker US dollar, which supported emerging market flows, also led to the rand being a beneficiary and reflected the improved risk sentiment by investors. All this positive momentum comes against the backdrop of trade developments which are once again in focus as the White House reiterated its position on tariffs. On Sunday, U.S. Commerce Secretary called the 1st of August the hard line for countries to start paying tariffs, though he also added that nothing stops countries from talking to the U.S. after the 1st of August deadline. The question then becomes, is the market a bit quick to dismiss tariff impacts, especially after the recent U.S. inflation print released last week? Once the figures were released, analysts mulled over the details to see whether President Trump's tariffs started to push up prices. While there was some evidence of modest tariff impacts, notably the prices of many goods exposed to tariff increases over the month, which included fruits and vegetables, household appliances, toys, clothing, and sporting goods. However, these increases were offset by softer shelter costs, which account for 40% of the core CPI basket and slowed from 3.9% to 3.8%. With that said, the June inflation figures convinced the markets that a July rate cut by the US Fed was unlikely. Last week's inflation print is a reminder that it's early days and uncertainty is still high. The tariffs effect could still derail a September rate cut by the US Fed. While President Trump continued to dominate the headlines with more tariff letters, market participants appeared to be shrugging off the growing list of countries that are subjected to steep reciprocal tariffs. It was the escalating threats on the US Fed Chair Jerome Powell that spooked investors. This was evidenced in the US dollar coming under pressure. This was after reports were leaked that the president consulted a group of lawmakers on whether he should fire Powell. While Trump did not deny the reports, he insisted that it was highly unlikely he would fire Powell anytime soon. Despite these reassurances, investors remain worried that the central bank's independence and hard-won inflation-fighting credentials could be compromised. Even if Powell serves his full term to May 2026, there are growing concerns that the president will appoint a successor more open to lowering interest rates regardless of the likely economic and inflation trajectories. On the local inflation front, this week we will see the release of the June consumer inflation report that is due tomorrow. The Nedbank Economics Desk expects a moderate acceleration in headline inflation to 3% year on year, this from 2.8% in May and April. However, food prices likely contributed to the uptick, while other annual declines in fuel prices continue to exert downward pressure. However, the fuel-related drag is expected to diminish in the coming months, which should see headline inflation drift higher, although not expected to breach the 4.5% target midpoint on a sustained basis. The upward move highlights the challenge that is facing the South African Reserve Bank if it aims to shift expectations forward to lower the 3% target. On the international monetary policy front, the European Central Bank will announce its interest rate decision on Thursday. The market consensus is that the bank will maintain its current refinancing rate, but the bank's revised inflation forecasts will be closely watched after the US announced a 30% tariff on European Union goods from the 1st of August. Meanwhile, the People's Bank of China is expected to maintain its current policy rate at current levels as well. We have come to the end of our note. Until next time, do take care from the multi-management team.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.